right? And the first topic today is going to be about whether or not it's too late to make adjustments here for your financial plan. The bottom line is the answer is no. It's never too late, right? Meaning that as long as you're trying to keep your eye on the ball on what the cash flow ins and outs are going to be, and then how you're going to, down here is the very wildly misunderstood aspect. I've always been saying this. You've heard this from me a number of times in different ways. You've seen it in different ways, certainly, which is that, for me, we simply do not understand as a collective whole, not me, but as a collective whole, we do not understand the denominator well at all. And we misunderestimate its importance wildly until we don't, in which case at that time it can become too late to recognize its importance. Most of the period over the past pretty much the year has been turmoil over the fact that the denominator here is no longer straight down, is no longer with zero volatility. This is not normal 10 basis points a day swinging up and down. Just is not what we are used to for decades. And literally, this is what, if you looked at the other videos on Jay's Corner, you'll see it there. I've left you the information there. Is the reality the entire way, which is there's a video, worst bond market start ever. True. What is that? That is R. Because R has increased to this degree, what has happened is NPV, household net worth, pension liability, etc., etc. All of these things have been dragged down. And from there becomes the difficulty, of course, because as a result, you have to then project forward. And we're going to get to that. I'm going to try to get to that right now. Let's just see if we can window capture here. So let's just try to get to it here. Yep, there we are. And this is, just to give you an idea, this is the video of where I am talking about the fact that that people don't understand inflation and the impact, which is just another way of me saying, look, people don't understand, to the degree of which interest rates and their importance. Ultimately, that is it, right? Ultimately, that is it. Can't believe I'm still this bad at it. Okay. We'll get better. We'll get better quickly. There we go. So what I've done here is I've created a spreadsheet, just a working spreadsheet on how I'm looking at it. And this is an outlook on the Comprehensive Financial Planning Service, right? In other words, everyone's pieces on that NPV, on this diagram, right? I am basically measuring NPVs for persons, different households, assets, liabilities through time. Right? And then figuring from there, understanding what risks people can afford to take or not. Only from that spot, once we get to those conclusions, then we can fit what risks are going to be acceptable in your portfolio, where these assets have to sit in terms of asset location, what accounts. Because then it determines the cost of taxes later over retirement. Some person's going to want to bite the bullet today. Some people need that cash today, right? That will wildly change based on somebody else's, the way that they have their diagram work. And here it is. Ultimately, it's as simple as this. And I don't want to both oversimplify or over-dramatize things, right? The world is not going to end, right? This is not the housing crisis. This is not the housing crisis. And that's the reason for the videos, which is the video, especially the person from Goldman Sachs when he was the one that just stopped, which is that company balance sheets still very good. People still you know, not, you know, they're more responsible than individual households, right? In other words, it's very clear what companies have done, very clear, which is when interest rates were this low, when they were that low, what did they do? They simply, and it's really literally as simple as this, right? Which is they simply took the money and they borrowed at the lowest R possible. That's what they did. They took the cash, either kept it in cash in the bank account, or they bought back stock. They didn't really plow it back into investment into their own company. They didn't necessarily do that, and that can explain, for example, why, you know, certain energy stocks in the energy sector is so good, because they underinvested, basically, and so as a result, they have to play catch up now. That's something you will see. So anyway, let's go back to this spreadsheet. So let me first just say that, you know, when I normally see from people, I see, you know, oh, well, I got some snapshot of how I look and things like that. I largely find this to be wrong, right? Which is that the vertical answer here to get to this answer, this X, is just not a valuable number, right? It's not a valuable number for me. It's more important that we have these numbers in here filled out correctly. And from there, you can see the different parts of the videos on the channel, which is, again, what I don't love about YouTube, but we won't settle that here. Right? It also tells you that at different age divisions, why I'm not throwing rocks at certain age divisions. For example, you know, I'm a 29-year-old or a 20. If I'm a 16-year-old, I'm wondering whether or not I'm going to college. Because the reality is the influencers are making so much money up here. And I'm not sure if people know this. You know, $10,000 an Instagram post, that's possible. A post. This number over here can be big. Right? And if you're like someone who can dance well on TikTok, you know, your opportunity cost here is so big, and your profit and your employment income potential is so large up here that it could be totally rational to not go to college. Now, you know, my late father would be pretty angry at me, of course, because I'm too educated, perhaps, even more so for my sister with PhD. So on and on we go, and you can understand now why, you know, certain aspects about you need to be 80% stocks, 90% stocks, 70% stocks, just to me is, you know, maybe that was true. That may have been true, right? These estimates of A, B, C, D, E, these here now are thrown into question because of the fact that what people have rested on, right? This is known. And this is my point here. This is maybe known or absent. And this is, of course, why 401k, right, has changed it to 401, the reliance into 401k. It's not because the company is trying to rip you off. Okay. They don't have any interest in balancing this pension because it's complicated, unless they're contractually obligated to do so. This is why you have people working beyond 65. Why? And you can see it's very, very rational, and it should have some other, you know. So we have like total. You can see why the other videos. Because now all of a sudden these others now start to become more impendent. Right? Because these are either known or absent. This is now known. Right? So now we've got D versus E. And because of the fact that for persons in my age division, We're going to have a challenge now. In fact, it's probably more challenging to our age division than others. And the reason is because here we've seen by others, there were other paths, alternatives. Right? In other words, these other alternatives exist. They've always existed. Right? In fact, what you'll see, and I'll just go here under Inflation Takes No Prisoners, but you can see these other videos. Right? Why are they sitting up here? They're sitting up here, not because I'm trying to sell you an annuity. They're up here because at some point in time, they could have filled in this number here. They could have filled in this number. That also includes the life insurance retirement plan. So while I've stopped short of books that call it the life, there are a number of books that kind of centrally deal with these layers. I'll tell you the name of these books. I'll tell you them now, right? Volatility Shield. Retirement Miracle. Right? They are taking advantage of certain contractual carve-outs, if you will. Carve-outs. And what they are is to basically create this extra layer. So the idea that you would just throw them away and just ignore them and just say, okay, well, there are these fees, there are excess fees, there are excess withdrawal penalties, etc., etc. Those are all true. Okay, that is true. There are fees inside of an annuity when you put money into the coffee can. That's described here in this video on annuities. Right? That it's described here on this annuity. As long as you understand correctly what its function to be. Its function is not to, so that you can buy Facebook or, you're trying to take over Tesla. That wasn't the function of that money, those monies there. And as a result, the idea that it's all or none, and we're going to get to all or none, when we get to Medicare, which is the idea that it's all or none is just not possible, right? Because to some households, this function here is very, very important. Who are you? You're Mr. and Mrs. Perfect at 60 years old. You don't have tons of retirement assets, but since you're Mr. and Mrs. Perfect, you're looking at 95. In other words, you've got a plan way out here, right? This is not 2037 at all, right? You're talking about 30 years from here. In other words, you've got to cover these liabilities on cost down here for a long period of time. Right, so as a result, that person wildly different. Of course, yes, you're Mr. Sick-a-Lot. This doesn't work for you. Why? Because the time that you're going to be able to get the lifetime income is too short on a probability adjusted basis. And now you have it. Because inside some of these annuities, as I've pointed out in that video, you've got other kickers, which is a good reason for the annuity, which is that there can be where you get a higher payment amount, a higher part of this yellow band, if you can't take care of yourself, for example. The issue is that now, because these are now known, right? Because if you are part of defined benefit, right? You're either absent or known. right? So you can calculate kind of or project out what this to be over time. And you can obviously see Social Security. You're in for another pay raise this year for persons on Social Security. Absolutely. The issue is that now we get to this number. Is that now you've got to start withdrawing from these monies that you have believed to be part of your nest egg, your savings that are in qualified funds or in non-qualified, right? Because no one said that this was just 401k. You may have other savings in cash, for example. This is about the function. And now you can see what ends up happening is that because of all of the interaction of all of these line items, right now you've got inflation here. And now you've got timing of taxes here. And now you can see why the reality is that this number here is just not that informative. Because now we've been living under the idea that China has exported deflation. I mean, that's actually what China's number one export has been. It's not, cheap Nike goods. It's the fact that 1.7 billion people have gone from fifth world economy to first world economy and a snap. Right? And as a result, because of that, they've pushed down inflation that would have otherwise been there. And so as a result, with this now released, and now you've got other external factors over too much money coming, the Federal Reserve owning 1/3 of mortgages. 1/3 of mortgages the Federal Reserve owns. They've not sold yet, by the way. That's why the other video in the loop, which is how disastrous that video clip was. Which is that now you've got this inflation matter and this number is higher. So now it increases the stress here to this. And this is also why it's not too late. Because it's not only for this period of time, but we've got to look into other years. We need projections about how you stand. Only when you have the projections, then do you go to, okay, this line here. And you can see how this changes wildly from household to household. Because of the fact that some persons have glossed over the idea and just presumed, oh, well, I'm just going to be able to have this C. Because why? You thought that, okay, the investment withdrawal is always going to be XDDD dollars as a result of the fact I'm going to withdraw, the 4% rule. There are these benchmarks that exist to say, okay, I'll be able to withdraw X% of my retirement savings. Well, guess what? You're now at 0.85 times 0.4, right? Because balanced retirement fund minus 15% is common. Something that I've pointed out on the Substack. Again, please subscribe to this Substack. There are too many things to be in a video. And I understand that, it's very unlikely that you're going to be able to watch one 10-minute video from me, one 20-minute video from me, and be able to put all the pieces together. I'm doing this as part of the financial planning service as a whole. Right, so you can see what ends up happening here is that what the follow-on effect is then, okay, what risks can you afford to create this DDD line item that you can accept? And now you can see these ripple effects because now this one here, inflation is higher. This line item, this green line is higher. If you take a benchmark, a 4% rule, just as a number, 4% of whatever your retirement balance, your 401k is, you have introduced sequence risk into the situation. And so what we have here is that at the same time, in order to meet bigger numbers here, that means you're accelerating selling of withdrawing from your 401k, which is the same thing as selling at the low. Right? Because if you're selling today, in order to get D, and DDD has to be higher as a result to meet higher inflation, basically what ends up happening is you've got this double whammy. And this is the difficult spot. This is the difficult spot that everyone has, and it's not going to matter, unless you're worth $10 million. But then if you're worth $10 million, to be candid with you, and we've got clients that in that number, right? It's the 26-year-olds and the person with $10 million. They love this minus 15. They want Google minus 30%. Absolutely. Right? Why? Because that increases their probability of having higher return on investment from that spot. Very simple. When there's financial turmoil, you know this. You don't have to have my degrees to know this, right? The rich get super rich. Why? Because they're not the ones withdrawing here at DDDD. They're not. They're the ones increasing their allocations to equities, increasing allocations to riskier assets. That also means you're 28 years old, you're a young professional, you're going into your 401k. You want this. Why? Because this timeline here for you more likely is much, much, much longer. And there you can see it. Fairly straightforward. Fairly straightforward. Where are we going to go next? 25 minutes, and I'm trying to keep this as short as I possibly can without getting too deep in the weeds. So basically what the takeaways here are: can you make adjustments? Yeah, you still can. Right? The reality is that it's always been my thought that you control these down here. Right? We are trying to be as I'm a cheapskate. The idea of me buying, clothes on full sticker price, no, that never happens. Only under duress. I've gone traveling. Ooh, I forgot, boxer shorts, something like that. Okay, maybe I have to in a pinch. But other than that, I just don't. Right? Because why? I'm trying to push down this green line. And now you can understand why I'm talking about Medicare, Medicare Advantage, Medigap. It's not the slam dunk that people are going to say. We're going to get to them in Clark Howard, in a few moments, or in more than a few moments. You can also understand why I'm being this particular about the timing of taxes. That asset placement affects the taxes to the ripple effect is up to here on the requirement of the withdrawal. And now you can see these other elements sitting in here, because now all of a sudden this item, life insurance retirement plan, for example, the withdrawal from the cash value in loan form, which is the retirement miracle, actually not only gives you the cash here, and let's just put this as FFFF. No, I called it EEE, didn't I? So anyway, let's just do that. I'm doing this on the fly, of course, as you know. Now my withdrawals here, if they're tax-free, also now push down the purple line. So this is the shield, the volatility shield, if you will. Right? Why? Because it slowed down the retirement withdrawal from 401k, allowing you more time here for other scenarios. I didn't say guaranteed. I don't have a crystal ball. I can give you scenarios where we're continually down and it lasts a long time, a lot longer than discounted in the market, a lot longer. But the reality is that that's why these other components cannot just be shooed away. If you're in a different age division, 30s, 40s, 50s, these other elements here that Fisher Investments say, okay, the pitfalls of annuities. I get all that, and that's not necessarily wrong. I'm showing you them here. Right? You're not gonna outperform in up markets. You're not. The formulas are intentionally set to cap your upside. Why? Because it's protecting you on the downside. And for that is not risk-free, right? If you try to buy a put on your entire equity portfolio, I promise you're not going to like the price. Wall Street's not going to sell you insurance on your 401k for cheap. They're not. It's going to, every year, it's going to cost you, 5, 6, 7% a year, right? To protect your entire portfolio. They would be able to sell it to you, by the way. But that's how much it would cost. So the idea that we're eschewing away, oh, well, there are high fees. Of course there are fees, because in the background, they're managing that. The flip side is it does have a function, because out here, this FFFF is a contractual number. So now all of a sudden you're here. Right? Retirement is 10 years away. Well, guess what? Fisher Investments, and there's nothing wrong with Fisher Investments. I don't know anything about them. No, I do know something about them, but this is nothing against them personally. But that's the way the investment community is set up. They're set up to throw rocks at this yellow line. Why? Because it lowers their fees. The flip side to that is that they cannot guarantee this number. They cannot. Right? If they're trying to guarantee you that they're going to hit this number, guess what? That you're being told an untruth. What instead you're being told couch language, well, like stocks in the long run, outperform. Well, that depends on the time frame. And you can see what has happened is if your DDDD is too big, at the time frame that the stocks go up, you've burned through, because you've required this in order to pay for these costs down here. And this is the weakness of the stock brokerage community, which is built intentionally to tell you this. That's their inherent, where you stand depends on where you sit. Fees whether that be in and out of mutual funds and you get the sales load, whether or not you have the 401k, where there's a fee, whether or not it's your, wealth management account, that's built in to stay in here. Why? Because that's the fee that's being built on the assets under management. It, however, inherently runs into conflict with the idea that the point of this F over here is that these numbers are in stone, right? For in an annuity situation. And in life insurance situation, what ends up happening is, again, a little bit more nuanced. I do describe it, right? I've described it in which video, and I'll show it to you here. Let's see. Ugh. This video here. This video here ultimately comes down to, right? Ultimately, this video here comes down to the idea that if you're in the right age division and if you qualify, you're depositing money into life insurance, but rather than getting caught up into the idea, okay, well, this just pays off when I pass away. No, that's actually not the function here. That is not the function here. The function of that contract is, and it's Index Universal Life, is to try to create this FFFF, this number here. And the way it's able to do so is because you can pull the money from your cash value in loan form and still retain, which has to be repaid ultimately when you pass away. But you've gotten the function of the FFFF. Okay? So this is part of why Jay's Corner sits. Right? I'm not sitting here focused on jargon. I'm focused on how the components are built and the function of what these contracts are doing. They're doing. Okay? And then you can understand why GH2 Unfiltered walks like a duck, quacks like a duck, duck. By the way, if you happen to have studied how a duck gets priced and valued, you don't care if it's a duck, you don't care if it's an elephant, right? You're able to price it and then compare it across the different alternatives here so that it can fill these different functions, as you can see here, as they go through time. The fact of the matter is that many people have the overwhelming most, have just simply said, okay, we have bought into the idea of, look, stocks in the long run. Well, yeah, that presumed inflation basically absent. That presumed that my 401k is plus 5% or plus 5 to 10% a year. So now you're at 100, right? You're not at 100 now. You're at 85, right? And why do I say you're at 85? Again, this is best in the world. Right? This is best in the world. This is not, Joe Schmo here. This is world's largest asset manager. They're creating these models that I've tried to explain to you, over a year ago. Over a year ago, I found, massive displacements. And the displacements that I saw were because I understood how the model worked that they're creating in here. Okay? And it wasn't because, stocks in the long run. It had nothing to do with it. It wasn't because I had a view on GameStop or AMC or Google. That wasn't it at all. What I found was displacement amongst all of the different asset classes and the inputs that these models are built on. And from there, you could also find the outperformance for the highly observant. Right? Which is that if there was that the model told you that, and this is totally rational. Again, this is 100% rational. And this is, and you can see, it didn't matter. And this is why on the, and there it is. And this is Vanguard. So what, coincidentally, with the same target date, two of the largest asset managers on the planet with unlimited computing power and unlimited modeling capability, what happened to come within 0.2% for the year under this type of volatility of asset classes? It's just not possible, right? You don't just need your common sense to understand how we got here. Okay. As most of you know, I do a very bad job of self-promote. Well, The information here is, it's the first time that I'm going to mention, it's the first time that I've mentioned what I actually do. There's no question about it. And I don't have a second place. My expertise is not about Medicare. I've told this to you on multiple occasions. Medicare just happens to be the one where, right? Yeah. It just happens to be the spot here. The reality is the real art, if you will. Art's probably a bit dramatic. But the real skill here actually is I'm focused on down here. I don't care, right? I really don't. I don't care how we're getting, what setup. Different people have different setups. We're not here to cast judgment. Okay, I should have decided to be you could tell me now I should drop this entire thing and not post any more YouTube videos and do something entirely different. I have that thought, as soon as I hit the off button, but the reality is I'm trying to get you to get to this spot here where we're max net worth. Given the facts that you have, given the fact that this number here is ultimately still subject to the lattice formula, the lattice diagram, right? And that's that funny looking triangle where I'm pointing out you're always at the starting point. Since you're always at the starting point, that means by definition that this can be adjusted. And my assessment about and combination and conversations with clients is about that, ultimately. It just so happens that I've written this book and now you can understand why this topic first. That's a very good point. And that now you can understand why the topic first, and you can see how widespread the shortcomings are, and you can even see it here. So we're going to keep going, and then I'm going to go to the market. But this is Bob Powell. So for most persons that follow here, and to newcomers, I would consider Bob Powell a professional friend, absolutely. I have appeared on this particular location, 3 times a month, every single month. Once a month we get together, we spend some time on 3 topics of my choosing. He asks questions and they're snippets. I'm not the only contributor, of course, and here's one here. And now you can understand why all of these, articles exist. Okay, well, I got my payout, early retirement payout package suggestion. Maybe that was voluntary retirement. I took a payout package. Maybe that was involuntary. General Motors, as you know, they said, okay, no longer are we going to have defined benefit. You can take your lump sum or you can do X through Prudential. That's what they did. And then we had all these articles and we have all these asset managers running and said, do this, take the lump sum, etc. And that's all that I'm not saying what is right or wrong. What I am saying is, did they go through this? The issue is that the brokerage community wants you to say take the lump sum because that is based on their fees from here. This doesn't make them, criminal. No, absolutely not. Right? I'm just saying where you stand depends on where you sit. I'm only saying where you stand depends on where you sit. Right? And so now you can understand that this is the motivation, the natural inherent motivation. My motivation is slightly different, which is I'm down over here. Nothing else matters to me. That if we get the right guidance, over here than this number here, so you're not sitting there worried, or you're doing the most given your facts. Given your facts. And you can see it here. And I'm not saying any of this is wrong. I'm not going to read this to you. But I'm going to show you one thing that's absent here. We go right into options. My issue is it's got no health adjustment first. And if I have healthcare cost as the dominant downside, it's not only the dominant downside, but it's also telling me something about this line here. How we're making these recommendations or thoughts about this line. So this is the payout. Let's just say payout options. How we're doing this without a look. Yeah, maybe your payout options is here. Maybe your payout options are, or you need to think about it out to here. For me, you start with what your likelihood is here, what this time horizon is here. We cannot just do this in isolation, and this is the issue with this article. Right? This is a qualified person to some standard. I'm not going to dispute any of that. I don't know this person. Right? But you can see it here. It's gone straight into, well, here's, how to look at it. How about we decide on whether or not, and you know who you are, Mr. Sick-a-Lot versus Miss Perfect. They're going to have a different probability of these payment options, which totally first, even before you get into this spot. Instead, we just dove into the second level with ignoring the first question. And this is the kind of glossing over that I just can't agree with. I can't agree with it, and now you understand also why, lots of time to this book. Lots of time, right? Why? Because its fit here affects your time horizon here so that you're max the net worth. And it's going to change through time. Okay. I got to that. Good. On we go. Not a pretty. You saw that, Vanguard, BlackRock, same thing, minus 15%. Totally rational. Totally rational. It's not that it does give you a benchmark. It doesn't mean that, false credit and false blame are thrown around in our society with, too much reckless abandon. You probably, if you watch my videos, you'll know this. If you've heard me speak, you know this, right? Our favorite national pastime, find someone else to blame, right? The other favorite national pastime, right, is taking false credit for this number here. So false credit and false blame is our favorite national pastime, right? Taking false credit for the fact that the S&P 500 has been goosed by Jay Powell and the Federal Reserve. And why? And how did they do that? Very simply, right? Very, very simply. How? They pushed down R. That's it. Yeah, no one's disputing that, Elon Musk is a smart person, right? The line between, nutbag and genius being razor thin. Elon Musk is not the first example of this, right? One of the most famous painters on the planet cut off his ear. But my point here is that in the false blame, false credit exercise, The reason for showing you those balanced retirement funds is to set you a benchmark of expectation, of what is reasonable that you could have suspected. Now, that's not to say that that was fitting for every person, right? That doesn't mean it fit the same for every person here. All I'm saying is that that's what the smartest, best in the world, using models of which could only be one construction, those were the results. If you had watched other videos, you've seen my thought process on about technical analysis. I'm not a technical analysis person, right? I am, however, a auction theory person, which is you're establishing price based on what other people are willing to pay, right? You don't have, this is why you don't hear me talk about target price. You know, that's a construct of corporate finance departments of investment banks, right? That is not the construct here of auction theory persons, right? It's just not. Because net present value here, this is a theoretic number. But the market mechanism is what someone is willing to pay. What's your house worth? Let's say you're the richest person in your neighborhood, owns 3 houses in your subdivision, and he's got a tax problem, and he's got to pay $2 million to the IRS. He liquidates his 3 houses in your subdivision. What has happened to the value of your house? It's not higher, I promise. Right? If that person's a forced seller, he's pushing down the value of your house. You're involved in his finances, whether you like it or not. And this is just common sense, right? I mean, if you then try to liquidate your home and you're the 4th seller, guess what? You're not getting what you got before he got the IRS levy. Just not. Right? On here, again, don't use this line. Use these lines. We now have to back up. You can see it, right? Based on technical, this is why that Josh Brown, no, you can say what you want, but there's happy talk. So first of all, quick review. This is the most consecutive negative red candles in a row since 1923, something like that? The most. 8 in a row. Oh, and as I said in the past, if in the scenario you were down, you were likely to find out whether this zone over here, this congestion zone, that's the language that I used. Why? Because at that point in time, there was a controversy about what the coffee mug is worth. They're testing. The big participants are testing. And this happens at every single time frame. Every single time frame this occurs. And that time frame could be years. It could be a quarter. It could be a month. It could be a minute. Right? That lattice, the good thing about that triangle, and I didn't have the preparation time to show it to you. It'll be up. I've sent it out on the newsletter on multiple occasions. You can see those little time elements. They don't have labels there. And that's what I like about the diagram. Because to different type of persons, different investors, this means different time frames. It 100% does. That doesn't make the participant in those who look at different time frames wrong. That's number 1 takeaway. And number 2 takeaway, that doesn't mean that their framework of understanding is different either. It is precisely what I've been showing you. And here it is here.
Scales off and then be able to sit through these pops higher. So I'm getting, those who follow me for a long time know that I just don't like trend days. They generally happen a lot less than two-way trade.
Oh, hello. This should look a lot like the lattice, right? Because all this person is doing, and I'm not trying to minimize this person. By the way, if you're a day trader or you want to day trade and you don't understand what this person is talking about, you should get out. I'm just telling you, right? But there are more similarities to what I've shown here on Jay's Corner than there are differences by a long way. In fact, what he said, he has his own separate set of jargon here. He has his own separate set of jargon here. VPOC, he's going to talk about deltas. You can see him drawing what? He's drawing probability. He's drawing you a probability distributions. And if you look at his videos, you will see. Oh, oops. I defy you to show me the difference between this and what I've been trying to show you on the lettuce. There is no difference. And now you can understand it's fit. Because ultimately, I'm thinking through on this, how much variability is going on down over here? You bet you. Just so happens that my time horizon here is longer. That doesn't make it different. And here's your punchline here. Literally, this is the glue. This is some of the glue that you can evaluate me. I can understand that. Unfortunately, I have to report to you. I've started to watch YouTube more because to hear what they've got to say about the financial markets turmoil. It's scary. It's frightening, actually. But also in here, because it's hard to tell who knows what, I'm very certain this person, well, I follow this person for a long time, is the reality. And I'm not in there doing what he does. He's involved in the futures markets of the major indices, and this is only on the S&P 500 futures index that he's making these comments. He will make other comments about other indices, when it's less eventful. But you can see his same technique here. His time frame is just different. You can see he's measuring, and he's trading in and out and advising persons, etc., for his own account or others, etc., at breakneck speed on multiple points during the day. And, oh yeah, by the way, he's willing to, you can also see, very important last takeaway in this comparison, he's willing to change his mind. Right? Meaning,
this 38.55, this is expected to take that out.
You'll see this almost every day.
Pretty aggressive coming in. So that's the outlook.
You can see it.
Today, I leave you with that. I know I normally put up the trading plans for the day, but to me, as you look at this and how it's shaping up, so you got this higher low, higher swing high, back into this is likely to be an open auction out of control. To me, this is a market that is definitely dominated by bears, by sellers, but it is having a hard time. You can see right now it is having a hard time kind of staying near lows or squeezing lows. So very important indications right at the open. So watch carefully, and the key elements to...
So you can see it here. Number one, you think these guys are just like guessing and punting around. No. 100% no. Right. And the idea that Joe Broker has any idea of what's going on here is also no. Just no. So the idea that you're going to talk to some kid who says, well, Facebook is down by 50%, let's just buy. All right. Congestion zone, longer period. You can see it here. Based on that, off and an oversimplified version of it, no question. No question, which is what I've been saying, is that, yeah, on in down markets, yes, you're going to come to this congestion zone. The issue is down here. You back this up. So what are you looking at here? Maybe here. Right around here now. Okay. This is another 15% lower. From this spot, right? 3,900 to 3,400, somewhere in this area. Into the 3,500 in this zone here. Is 400 divided by 39. 4 out of 39 is slightly more than 10% from this spot. If you take 3,400, 3,500 and divide it by 47. What's 35 divided by 47, you smart guys out there? Slow people like me. This means you're minus 25% on equity for the year. That would be the zone here, so I'm not saying that's what's going to happen. I'm just saying that that's what the market and congestion zones on disagreements on the value of the coffee mug might tell you. What is different, however, than 2 weeks ago is the following. The first 4 months of the year have actually not been too complicated, right? In other words, the turmoil is basically just interest rates higher. That's it. Interest rates higher. Creating problems, and oh yeah, by the way, inflation's a problem. This higher, everything else lower. Easy. Not complicated, actually. So the reality is, if the models told you that minus 15%, but candidly speaking, that is very counterintuitive, right? Or counter theme, meaning that if you just simply lowered your duration risk to the fixed income market, you can beat the 15% benchmark. No problem. Candidly speaking, I can tell you, and the stable has been set up in that way, right? It's just let's lower what we would normally expect and know to be right. We know that this was happening, right? We know that this is how the model is built, for sure, right? I was pointing this out a year ago during the GameStop matter, right? Which I've always known, right? It just gets glossed over by happy talk when interest rates are stable. When the asset covariance and correlation matrices, if you're on linear algebra, I'm oversimplifying. You'll forgive me, but those persons ask cash versus stock, stocks versus bonds, international versus domestic, etc., etc. All of these combinations are compared and measured. That went to kilter. When that got screwed up, I started raising eyebrows. I started firing off videos. I created Jay's Corner because of the fact that these correlations got screwed up. And because you know what the model says, that it's still going to be some amount into fixed income, that you could just sidestep the entire minus 15. Not the entirety. You're not going to sidestep you could outperform the minus 15. How? Just simply lowering the amount into where they would have to be, which is into the fixed income. And a notable amount in the long duration fixed income. And so now I've talked more technically, obviously, right? Because you can see it here. Not very pleasant. You can see it here. Open it. This is year to date. You can see it even worse. High to low, 154 to 118 on a U.S. government bond. Right. So from 150, so now you've lost? You've lost 38, 36. You've lost 36 out of $154, which is basically matched, which has matched QQQ, the NASDAQ 100. It has matched it. In fact, it's worse. So risk adjusted, this is actually much worse. This was supposed to be more stable. Obviously this borrower is not Tesla. It's not Apple. Apple is, it's not going to default. It's not going to be bankrupt. But still, nevertheless, it is still not as stable as the U.S. government as far as, credit worthiness. It doesn't have taxation power. But now trickier. And we're back. We're now to the punchline here, which is now over the last 2 weeks something new. Is that these numbers here that you're going to see, for example, let's just go here. Actually, we can take an indicator. It stopped going down. Equity's gone down. It stopped going down. Why? This stopped going down. This, in fact, so remember that bond prices go in inverse of this, right? And I'm using the 30-year here, but more correctly the 10-year. You'll see a very similar thing, just a different scale. The yield curve has moved, but not dramatically. If anything, it's flatter between 10s and 30s. A technical point, one beyond today. I could explain it to you, but it's not that interesting. Maybe it's only interesting to me. This is the 10-year, and you'll see that the same direction here. We don't know exactly how this happened. We don't really care. We can, pontificate. No, we do care. You can see that all of a sudden we've gone from 2.86 3.14 to 2.8. This looks small. This is 0.4. When the denominator is 3.2, 3.14. In bond space, this is enormous. From some location, monies have finally gone into the fixed income market, despite the fact that the Fed hasn't started selling. Despite the fact that the Fed isn't done raising rates. And now, if anything, this is now both good and bad. I'm not going to say, I don't know. We're not sure. Nobody knows. And largely because you're not going to get a memo. You're not going to get an email to say, okay, here are the parties that bought. Because this could be big. This could be just selling stocks back to normal. Okay, we've gotten our stock run. We're down to 85. That's fine because we've got bigger fish to fry because our job is to pay the pensioners of our nation. And so let's sell stocks and go into bonds. The yield is high enough. Okay, maybe they're done. Maybe they're not. Maybe they just started. You don't know. We don't know. All I'm saying here, it's become more complicated now. Because what was easy, which is, just rates higher, now is a lot more congested, up and down. And so you're going to have this whipping around and unsettling thing, which actually may be okay for individuals. Because in that individual instance, that you can see that this pink guy here has started to flatten out. Down over here, it's been very volatile in equity land, but down over here, the targeted retirement fund hasn't really moved around too much. I mean, it'll seem like a lot. Don't get me wrong. But you can see started to flatten out, even though markets are moving. Equity markets tell you, wildly up and down. That doesn't mean the coast is clear. What it is telling you, though, that one of the locations that the big funds and et cetera, would have been into, which is the fixed income market, has started to stabilize here. Whether or not that holds up is the open question. You will see this. If you see on the CNBC, there will be someone called Art Cash, and I tried to find his clip. He didn't have it. It's in behind a paywall that I don't subscribe to. Right? And I would agree with that, which is we don't know, we have not seen what happens when the Fed actually starts selling. From there, you can understand whoops, sorry about that, everyone. Most of that other stuff was, let's shut this down. So back here, basically what I'm saying here is that you can see that the 10-year note interest rate has gone down. It has not been the one-way train of higher interest rates has abated. And this is what I was paying attention to. We're not exactly sure what the cause is. And like I said, we're not going to get a memo. You can remember I said don't use this line. You can't use these. Here you can see it. It's better when you do it on a weekly, on a daily. You can see how this one-way train has stopped. And so now my eyes have bulged out to watch this again. Of course. Right? Fairly straightforward. But just saying it's new, it has changed nature. For me, this has changed nature. This isn't necessarily bad. Right? Because lower interest rates ultimately you'll know that I've said in the past, or you may have heard, you'll have seen, which I do agree with, and why the NASDAQ is basically inverse, is basically following the bond market. Why? Because the C1s here are just not that big, right? You're talking about future projects where the C's are way out in the future, 10 years, 20 years, 30 years. They're not Cheerios, right? They're not selling Cheerios, right? But you're basically investing in the future prospect of CT, where these are way out in the future. So if these C1s here are real low, and you have to keep waiting out here, and at the time that R is much, much higher, what happens? The NPV is much lower. And that's your explanation for what has happened to the NASDAQ. Not because Tesla is selling less cars. No. It's simply that it is the most sensitive to this construct. That's it. Which happens to be pinned to R. Not coincidentally, stocks for show, bonds for dough. That this movement is so big that it's rippled up into question, and now this is why this explains Target and Walmart. That part of R, what's not well explained is not in it, R is the market rate, and the subcomponents are inflation plus inflation expectations. It's real interest rate, which is basically the return on real assets, plus inflation, which is the nominal inflation today, plus inflation expectations. Those are the subcomponents of R. And that's the Taylor rule of, for you macroeconomists out there. So anyway, because of those things going increasing, and you have Netflix with lower subscribers. So this down, the denominator higher. What happened to NPV? Plunged. I did remark offline to a person who is too heavily in Q and glossing over these aspects, telling me, Apple does this and Google that. I'm like, look, interest rates up, NASDAQ minus 30. Ding. And this is just me pontificating, to a person just for kicks. I'm like, that scenario exists. Absolutely. That is what? 7 months ago, 8 months ago. That scenario exists. Does that mean that you slammed your stake into the ground at short the NASDAQ to that degree? No. I didn't say that. I didn't say that was 100%. Again, this is not 100% anything. If it were, well, I should play Baccarat instead. Right. I don't need to make these silly videos. These badly produced videos. Okay, so let's keep going. I wanted to point this out here because the structure is different and it's going to change every week. While R is so unsettled, still unsettled and still yet to be determined, NPV is going to swing around. NPV is going to swing around. And how that affects you? Well, very simply, it affects you because of the fact that now all of a sudden, it affects you, the timing of when you need this money here. When do you need this money? Right? When do you have enough to cover expenses? Right. Do you have enough to go on the trip that you want? Oh yeah, by the way, your trips to Europe on sale. Right? Absolutely. Euro down from 122 to 120, 125 down to 1.05. Basically, Europe's on a 15% sale for every American. Okay? Well, their inflation may have gone up by 20%, so it might not be on sale. But you can understand my point. It's 15% lower than it would have otherwise been, inflation not adjusted. If you want to go to Paris, Barcelona again over Paris every day, by the way. That's it for market talk and its ripple effect here to financial planning. Okay. For those of you not yeah, brother. So this is not a happy day here. Because the link here is the following. Let's try to be as kind of as nice as possible. The entirety of this book is that, look, one size doesn't fit all. How can one size fit all? How is that possible? It's and for some a party to say, okay, well, even if they acknowledged that one size doesn't fit all, I wonder why this is happening. Other than I don't know what I'm doing. No. There's got to be something that widen. Getting better. A little scary that I'm getting better at this. So yes, I have actually more faith in the everyday person than you might think. And that's, the reason I spend this time here is because while I'm the overqualified to describe this book or the 10-year note, that I think that the explanation and the what people are being provided in public is terrible. Sorry. I think it's terrible because it's just too extreme. It's too extreme to say that one size fits all. Just cannot possibly be the case. And I don't also think that people are stupid. I don't. Right? You've experienced stuff that I will never experience. I've experienced stuff that you will not experience. You have circumstances, a DNA, different circumstances, different situation, etc., etc. It doesn't give me the right to put myself in your shoes and just decide for you and say, okay, oh no, just follow one path, my recommendation, my opinion, and that's it. That's just like laughable to me. The flip side of laughable, right? The flip side of laughable is I gotta laugh at this. Sorry. I have to. This can't be right. When I hear that Medicare Advantage is bad across the board at every, right? Not to the person where this cash need today is more than is $300. Right? This person there's some persons here who need or want $300 a month. Which if you're a married couple on Medicare, right? That's your Medigap premium, $300 a month. Now in 2012, 2013, which is the first year that I wrote this book, right? That was different. Why? Because the difference in premiums between Medicare Advantage and Medigap wasn't $300 a month. In fact, Medicare Advantage, in certain instances, was more expensive than Medigap. That existed. In fact, I can tell you of a person who went to the wrong school inside of the state, went to the wrong college inside of the state of Michigan, right? The clearly inferior one. Anyway, which is all of them. Anyway, we won't settle any of that here, and I'm just kidding. Calm down. Is that Medicare Advantage plans, there were Medicare Advantage plans for $180, $200 a month. That existed. $200 a month. When Medigap was $140 a month. Plan F. That existed. 10 years ago, that existed. That also gives you very good light on how competitive Medigap is today. Because the price isn't notably different. It's up 20% over 10 years. What's that? 1.5% compounded? Right. So the inflation of the Medigap premium has been that low in nominal terms on a compounded basis. And if anything, Medicare Advantage has declined in premium. It gives you an idea on how disserving then stuff like this actually is. I'm going to step away. I'm going to turn off my microphone so you can listen to this. I'll intervene in.
I'm going to bring you an update. This is quite compelling and insightful. This is Clark Howard, who I've followed for many years. Clark Howard had millions of listeners to his nationally syndicated radio program, now a podcast, who was helping seniors to
So the fact that the person has millions of viewers is fine. The fact that it's going to be this biased is part of my outrage. Right? Which is now you're going to hear basically 10 minutes of, excerpts, which are going to say, okay, everyone here is all the same.
Navigate financial topics to avoid getting ripped off, travel deals, tips on how to buy things, and really a consumer advocate that never himself advocated or tried to sell one thing. Unlike Dave Ramsey, who tries to pitch his courses and sell them through churches, Clark Howard has never had anything for sale. He's only told the truth. And today, I'm bringing you what Clark Howard has had to say recently, which has opened a lot of eyeballs out there about Medicare Advantage. Take a look.
Today, I have not one, but two special warnings for you. The first deals with Medicare. And something that has been so confusing to people when they are approaching the age of Medicare eligibility, 65. And also want to talk about an alarming trend in mortgages.
Now, this is interesting because Clark Howard himself is 66 years old. So he just went through his initial election period last year, turning 65. And this was kind of an eye-opener, especially for a consumer advocate as strongly willed as Clark Howard.
All right, strongly willed. How about we be strongly willed to saying, so I'm strongly willed, right? I'm pretty strongly willed. I'm strongly willed to say, hey, guess what? Every person is not the same. I'm strongly willed to say, it's not my spot to tell you how to value your money. How about strongly willed to be, here are the pros and cons on an even-handed basis? That's my placement of strongly willed. So yeah, okay. Strongly willed and biased is not helpful. Just isn't, because why? That presumes that person is you. That presumes that person knows everything about you and all your circumstances. It's just unbelievable.
And here's his take, in my opinion, along with it, about Medicare Advantage as it pertains to the difference between Medicare Advantage versus Medigap or Medicare Supplement. That is the program, Medigap Medicare Supplement, that 90% of agents that are walking up to you and talking to you about Medicare will curiously never bring up. Agents today are trained never to talk about Medicare Supplement as an option anymore. They only push Medicare Advantage because the money with Medicare Advantage is more than double when you get somebody new to Medicare. So listen to Clark Howard in his own words, repeat what I've been saying for the last 6 years.
All right. This is interesting. Number one, let's just address this. If you're new to Medicare Advantage and you come to us, and this fits your situation here, right? Maybe you've not gone through the comprehensive financial planning. Maybe you haven't. Maybe you just say, Jay, you're a Medicare broker. Somebody gave you my name. It said, gave you our name. We went through the work. We figured out where you lived, et cetera, and you want Medicare Advantage. Do we get compensated? The answer is yes. Is what this person is saying true? It is to a degree if you are, it depends. For example, what he did not explain is a couple of things. Number one is that's true for the first year that you're on Medicare Advantage. Or if you're new to that Medicare Advantage carrier. It is not true for renewal. We're playing by rules as determined by someone else. This is why, this is the nuance of why I say, look, I run a 7-Eleven, right? You want extra gum, you get extra gum. You want Trident because we've determined together that the Trident is the best fit here between living expenses and possible costs that you would have to incur while Medicare eligible. Okay. Do we control the compensation? We don't. Could the CMS change it? They can. Could the carrier change it? They could. I run a 7-Eleven. Tough rocks for me. Right? You would have thought, so it's also counterintuitive to some degree. You would have thought that people say, well, I disagree with the way that he's marketed this, which is he's trying to say that he's separate by saying, well, I've been saying for 6 years that Medicare Advantage is bad and all that people want to do is distribute Medicare Advantage. That's like 100% untrue. This book is already telling you what? It tells you that Medigap, the contract is locked in stone, in cement, in the buyer's favor. Very clear. Very clear. And for that, for those features, and the only one that can cancel is you without a network. And for that, you are paying a higher price. Very simple. Does that mean that the person that values the $0 because they need this cash here, because they're Mr. or Miss Perfect, that it makes no sense to try to drive down the cost? If they understand the nuances, again, right? Network, prior authorizations, right? Then annual contract. Forgot the most important part first. That the moving parts can move every year. Is what you get for not having a script. Is the fact that if you understand these matters and can deal with those matters, then you may have valued the fact that this is $3,600 plus, more than $3,600 cheaper per year. That's up to the buyer. That's up to the buyer. I'm the guy behind the counter at 7-Eleven here. Right? It's not my spot. So if you're going to call me opinionated, that's okay. That my strong opinion is it's not my place to tell you what you should do with your money. As long as I've explained exactly the implications, ramifications, which I've spent lots of time. Maximize Your Medicare, the channel, right? Which is a different channel than this one. Was it 100 videos? Different shapes and form, nuances. Can't get it in a 10-minute video. I've got a reason for saying that can't be done in 10 minutes. Let's keep going.
You yourself are the person approaching age 65. I want you to have a heads-up warning. When you are generally about 4 months out from turning 65, you will have a blizzard of traditional mail show up. I mean, like in the mailbox from what are known as Advantage plans, which are generally a disadvantage plan for you. Traditional Medicare allows you to seek care where you wish for the conditions that you might have. But if you go into a Medicare Advantage plan, as a new federal report finds, repeatedly, people are denied care. And
Now, if you've not yet seen that Medicare Advantage report from the Office of Inspector General at Health and Human Services, I really recommend you watching that video on this YouTube channel. The only one that brought it to you first that talks about the routine denials of care with Medicare Advantage. That's what Clark's talking about. Whether he's a subscriber to my channel or not, I don't know. But that's what he's talking about. It's been absolutely documented now that denial of care is the modus operandi of Advantage plans.
And it's costing people their lives and their health. Medicare Advantage plans were dreamt up as a way to reduce government spending on health care on the elderly.
Okay. Let's see here. How do we do this easily? Let's take a look at this article that he's talking about. There it is. Not DraftKings. All about MedicareAdvantage.com. There it is. The only thing worse than over bias is pulling stuff out of context, which is why I ripped the AARP when they called it no saving, no what? This is even worse. I went to the link, and the link is back to his own website. See, look, I was right. Here's the proof on this website. Oh, it's my website. Oh my God. It's worse than I thought. Article about Medicare Advantage versus Medicare. Prior opening includes information about American Medical Association, etc. Ralph Nader. See the New York Times article. No question. I'm not going to dispute that this is true. Often denied. Right? That's okay. And I'm not going to gloss over it. I'm already a member of New York Times. What are we doing? I'm not going to gloss over it. Often denied. So, are there hiccups here? Are there controversies here on Medicare Advantage? Pretty clear that I've said this is something where you've got a third party intervening. And that third party is the carrier. Is it possible that you require prior authorizations? The answer is yes. They are adjudicating. Is there anything that you can do about it? The answer is yes. There's an appeals process. Is there a fix for this? The answer is yes. No one's asking Jay, because Jay would impose a one-strike rule, which is that if you're systematically denying as a practice, if you are systematically upcoding on the risk adjustment, you're closed. I need the dissentive to be that powerful, because there's no doubt about the profit incentive, right? There's 65 million people. If I sold a pack of gum to every one of 65 million people, you're darn right there'd be a profit motivation. That's not happening, by the way. So you can understand my point. Are there combinations? Are there situations where this can happen? I'm not disputing the fact that it could happen. Is it as biased as this is? So it's pretty funny, because funny as in not funny. Funny is the nice way of putting it. Oh yeah, on the appeals process, that 75% are overturned. In other words, that if you appeal them, then they're going to have no choice. And if you win, you get it. The flip side is, whether or not the doctor is asking or recommending something that is not advisable. Again, where you stand depends on where you sit. Don't call me a doctor hater for the audience, for those who know, right? Beloved late father and medical doctor. So this is not about that. What I am saying, though, is this is not the slam dunk here. There are safeguards. Are they perfect safeguards? There's no perfect. That's not our world. Does that override this? It doesn't. Just like in the financial planning, and back to the first segment, right? Let's say, for example, that your numbers here don't work. For whatever reason, without judgment, right? That your retirement withdrawal here, your flexibility here is zero. Right? And why could this happen? I could tell you how this happened. Because your assets here are zero. That's a lot of people in the United States. A lot. Right? And these are zero. Guess what? This money that you would have allocated to Medigap, those are groceries. I have to accept the risk here. That can easily be the conclusion. Easy. Right? It's not a difficult one. This stuff here, the sum of it, I'm going to have to accept some some probability of this happening. Why? In exchange for what? Food. That's a trade-off that you take for many, many households. That's all I'm saying. That's literally it. Does that remove the fact that Medigap is stone cold in your favor? No. Does it say that there's nothing that the doctor can do? No. Meaning that, is there anything that the carrier can do and refuse your Medigap application when you're first eligible, even if you had 6 types of stage 4 cancer? I hope that's not you. No, doesn't. Does it also mean that Mr. Perfect, who's living check to check with 25 children, should be spending $3,000 for he and his, well, probably multiple spouses, but just one legal spouse, where this person is spending $3,000 a month and going higher, plus $3,000 a year, sorry, misspoke, $3,000 a year at the minimum for grocery money? No. You can easily come up with that combination.
But it's had a double effect, because the big insurance companies that push these Medicare Advantage plans so hard, and the commission salespeople who make a lot of money for getting initial enrollments of people at age 65 into these Advantage plans, everybody's pushing you into them because the insurance companies are making a ton on these Advantage plans. And how are they making a ton? From denial of care. That's the whole game.
Now, this is Clark Howard giving his opinion, and I'm giving my opinion on Clark Howard, but it's not just opinion. That is a conclusion, which I encourage you to read the entire study, which you can find on my video, from the Inspector General said, the reason why
All right, so it's my opinion that no one should have an opinion on imposing their judgment upon others. How's that? And instead that I should let the consumer decide after comprehensively describing the world of imperfect choices that exist. The idea that what he's talking about, so does that mean that Medicare Advantage is perfect? Again, it doesn't. It absolutely doesn't.
Why these denials of care are routine is because that is the profit differential. That's what it is. It's profit driven. So that's not just his opinion. That is actually the fact.
That's not what this said. That's not what this says at all. A central concern about capitated payment models, including the model used in Medicare Advantage, is the potential incentive for insurers to deny access to and payment in an attempt to increase profits. Yes, potentially the case. Potentially doesn't mean for sure, A. As these two, not only one, but both of them say is a lock conclusion. The flip side, and don't get me wrong, people might think, okay, well, why does Medicare Advantage exist? I'll tell you why I think it can exist. And why, actually, even though I thought at the beginning of Medicare Advantage, during the first edition of this book, that it wasn't because of its coverage, it was because of its costs for that coverage that it was inferior. Now that's different. Because the cost is zero. The cost to the buyer is zero. PPO. In most locations in the country, that's the case. Not every. Orange County, very few, right? There's not like 10 carriers like there are in, Ohio. There's like 5 carriers of $0 PPO in every city. The issue here is, why does this exist? I'll tell you why it exists. Because if I were the czar of the CMS, which I am not, and the CMS is not asking my opinion, I would absolutely use Medicare Advantage. Why? Because I would drive it down, because I'm trying to drive down the systematic cost of healthcare. Because I know that there's no solution to solving all the different fragments of healthcare delivery in the United States. Since I know I cannot corral the AMA, the American Hospital Association, big pharma, insurance companies, what do? I put the screws to Medicare Advantage plans and say, look, I want you to beat each other up and drive down the cost for me. So be it. You could tell me, Jay, it should never have been this way. It should, we needed in order to get to that spot, you would have had to rip it down to its struts. Rip it down to its struts. In which case, I've addressed how to do that. To get agreement on it is impossible. I can say that you never say never. Never in my lifetime am I going to see this. I'm very confident of that. American Medical Association, American Hospital Association, Merck, Pfizer, and other big pharmas, GlaxoSmithKline.
Sorry, I don't know that one.
Alexa, stop it. Right, to get everyone on board, to push down the systematic healthcare, American Nursing Association, who wants Medicare for all, incredibly. But anyway, to get everyone on board and to push down systematic healthcare costs is an impossible task. The best shot that you have is for the CMS to turn the screws. And how do they do that? They make the Medicare Advantage carriers compete against one another. And are there going to be ripple effects from that? Yes. Right? They're competing hard. To give you an idea, P&L's 3 to 5% is their projection. They're on record to say that, right?
Because that is the profit differential. That's what it is. It's profit driven. So that's not just his opinion. That is actually the fact.
Okay, and here's my issue, right? I mean, all of a sudden, potential becomes fact. You've pulled out of context something that isn't proven, and now all of a sudden you've leapt to fact. My patience is limited, if you couldn't tell.
Based on the
Is
experts.
that as somebody gets older, we got more things wrong with us. We spend more time dealing with conditions.
Oops. And then my punchline here.
His opinion. That is actually the fact.
And this is my point, right, is now all of a sudden these persons have assigned potential to stone cold conclusion in the face of the smartest persons in the world with unlimited computing power trying to fight for extra normal profits and 1% increase in market share in every location in the country. To be candid with you, I would just let these guys try to kill each other. Right. Again, I'm behind the counter at the 7-Eleven. It doesn't matter to me whether or not Big Red is beating up Trident or Trident is beating up Big Red. If the customer is happier, if the buyer, if the consumer is happier here, I'm going to have to accept that. That's what I'm saying. These persons here have left out huge pieces of information. And then trying to convince you of something of which is unproven if true. And if, I'm not going to say that it's untrue, right? I'm just going to say is, even if true, let's just say, for example, they were 100% correct. Guess what? To Mr. Sick-a-Lot, to Mr. Perfect, who lives check to check, it's still worth the risk. Can they both be true? The answer is yes. Is it 100% that these persons are just like, should be imposing themselves on you? The answer is no. They shouldn't be.
Based on the experts. That as somebody gets older, we got more things wrong with us. We spend more time dealing with conditions, chronic and otherwise. And if you can delay, deny, as an insurer, you're not spending that money. So you lose the freedom you have with traditional Medicare.
We just had this brought up last week. We had a person who was on a
That's what options are. Insurance is an option. That hockey stick diagram that I've shown on every occasion, on the overwhelming number of my videos, all are talking about the option value. They're talking about original Medicare. Original Medicare has unlimited downside. Unlimited there's no out-of-pocket maximum on your out-of-pocket costs if you have $1 billion of health care costs. You owe 20% of it. The idea, so what they've not even said here, they've not even talked about the fact that Medigap costs more. Guess what? There's a difference in quality of the contracts, of the angles, of the payout structure, of the cost. So all the stuff that they're talking about here at the beginning, right? Yeah, they're talking about the payout different angles, with no mention whatsoever about the cost. It's a financial contract. There's cost. There are payouts. There are contingent payouts based on situations. And the fact that this should be an individual decision, for me, is the almost unalienable right. That's probably a bit dramatic. I get it. Sorry about that. I don't like hyperbole, and then I've used one, right? Which is, for me, I'm behind the counter of a 7-Eleven, right? I'm to tell you exactly how this works. I'm going to tell you, okay, you're in this county. You can access your healthcare providers in this particular way. And given your situation, the money is worth it, the money is not. And the fact of the matter is, and we have this in Tampa, there's a person I met at a social gathering. What do you do? I wrote some dumb book. I have VA. I also have a give back plan. I get $140 a month. I said, okay, that's no problem. Then he says, okay, well now but now I'm thinking, I said, do you understand that, you've got to go to these, I may need some other care. I said, do you need this care? He says, no. I said, maybe. So you're speculating. I said, yeah. He said, okay, well, who's the doctor? I looked up the doctor. The doctor doesn't take the HMO. And I said, okay, well, you can understand that, you'd have to pay for 100% of the cost. And I said, what's the likelihood of you requiring to go to that doctor? He said, very, very low. And I said, will you be able to find a substitute? Yeah, maybe even the VA. I said, look, we didn't know each other when he signed up for the Give Back HMO. I said, look, you just stay there. That's fine. Because, you get this $140 times 12. $140 times 12 is $1,600 back to his Social Security check. How many times are you going to see this doctor? Even if that isn't certain, and you don't know whether or not you're going to go to him multiple times. I said, maybe once. How much is it going to cost? $250. I said, well, okay, you're going to give up. Why would you switch to PPO now? Even though I represent the PPO. I represent both plans. I'm behind the counter at the 7-Eleven. As long as the consumer understands the combinations and what the outcomes and the cash flows and the costs, then it's the consumer's choice. Here, these persons aren't giving you an even-handed set of explanation of what the combination is. They've not mentioned the fact that original Medicare by itself has unlimited out-of-pocket cost. I have unlimited out-of-pocket cost, and that becomes my constraint, and I'm living check to check. Every Medicare Advantage plan must have an out-of-pocket maximum. The end. That's the forest. They're into the leaf on a tree in a forest. They're not talking about the forest yet. Yet that's the one that they want to pin down on. And some elements are going to be true, and if there's wrongdoing, I've lost sympathy for the insurance carrier, right? Right? I didn't say that, and I put you this way. Let's say that you wanted to have Trident, and it wasn't killing you, and you got what you wanted from it. But, in their packaging, that they mailed it to the store in some way that they're not supposed to. Does that stop you from buying the Big Red? Right? In other words, in Mr. Perfect's case, when he's very, very ill and he has 25 children, does he care? Candidly. Just practical reality. Does he actually care the fact that the gum got there in some way that he may not have agreed with? Okay, well, if Mr. Perfect is standing behind his pulpit with a robe, maybe. I'm more about practical reality than that, I guess.
Plan G, and because of health conditions, they're getting rate increases and could not move their Plan G Medigap plan, Medicare supplement plan. And they said, well, maybe this year I'll just go to one of the free plans. And that's my concern in this area.
I have no problem with this statement per se, right? Can it be your concern to switch from Medigap to Medicare Advantage? Sure, it can be. Remember, there are side doors that you would have to work carefully with us on it. Have we intentionally used the side door? The answer to that is yes. Right? We are very specific here, way beyond a video. I wouldn't share it in public because somebody's going to mishandle it and blame me. Right now, I'm the seller of some contraband gum. That's a no. Right? But yes, if you understand the options and the flexibilities, then it's back to the buyer, right? It's his concern. Yeah, is it, no question, the concern can exist. Is it his or anyone's place to determine whether or not it overrides this?
As you're getting older, things tend to break down more often, not less often. And as health deteriorates, that's when the secrets of Medicare Advantage become available to you.
It's very unlikely over the next 5 minutes of this video that I'm going to change my mind about the video. It's already so far wrong, and from its judgment, it's casting judgment upon your money and your situation that can't be fixed. It comes back to here, right? I mean, I can easily come up with the rationale on the flip side, and I'm going to show it to you. And this is going to be the last tale for the day. The flip situation exists. Right? You're 85 and you start getting bills. Right? You start getting bills, and because you're on Medicare Advantage. Right? Well, guess what? First of all, did you know that was going to happen? Probability when you're 65. The answer is no. Right? If you had a crystal ball, you simply wait until, right? It's very simple. While you're on Medicare Advantage for $0, and then, or no, even more, right? You don't buy any insurance or other than original Medicare until a month before you have any medications, and then you call me up and you buy Medigap because you can pass underwriting. Okay, if you can cut it that thin, God bless you. You let me know, and no problem. I'll help you. if your crystal ball is that accurate, no problem. I can increase your net present value real well. But what he's saying here, it also goes the other way. And here's the flip side of that same type of matter, right? And again, this is your money, not mine. Your situation, not mine. And here's the rationale. Yeah. Let's just say, even with persons with money, right? And now I'm at the out-of-pocket maximum, which is now $5,000. And it's out here. Well, guess what? If we look at the formula, that was completely rational. Why? Because the NPV maximizing decision is that the minus is so far out that the value in today's terms still made it the most efficient thing to keep the money today. This is the value of anything. It doesn't matter what the financial construct is. This is the NPV. So if you had this crystal ball and knew the timing of the illness, very simple. Have I seen other persons use this to their advantage? And no pun intended. Which is, widow comes to me after the spouse passes away, says to me, we took early retirement. We took all the money. We took the maximum amount of money in payout on pension. Life only. Life only they took for the spouse. They spent 20 years traveling. And then after the 20 years, the husband passed away after severe illness, covered by group Medicare Advantage. Husband says, and again, I'm hearing the story. Widow says, my husband was trying to apologize to me that we did not think through what would have happened out here. Widow looks to me and says to me, yeah, you could say that. During these 20 years, we went around the country. We got to enjoy 20 years of retirement that we would never have been able to do if we had made a different decision over here. That if we had not made some other decision over here, in other words, what did they do? They valued this upfront C1 in these time periods and the utility of those monies at that time more highly than someone else. Their cloned couple could have had a different value system, a different priority set, etc., etc., etc. Therefore, their utility of that C is so different than the other household, than this widow and the late husband. The late husband I never met, just the widow. The widow looks at me and says, I don't regret this for a split second, not for a moment. Because that 20 years we were able to take early retirement and go around the country, I would never be able to get that back. So you can understand my ire. And you'll forgive me if, it's too impassioned. I'm going to ask you for your forgiveness on that. I cannot buy you this far biased that all of a sudden that one size fits all. Respect persons' priorities, their decisions, their valuation, their right to have valuation on this formula. Too much for any of that. Thanks, everybody. Don't forget jo.substack.com. This free newsletter will have other analytic stuff that, I'm trying to obviously I can't be the crowd because this face for radio and my nasal Midwest tone of voice. You'll have to excuse me for that. There's limited things I can do about that. Have a good Sunday. Speak and emails will be coming. I'm sure that